Hey, Renter Retires, it's Matthew Seyoum here with another episode, and today we're here to talk more about some Houston, Texas new construction with Ryan Smith. Ryan, how are you, sir?
Doing great, Matthew. Thanks for having me.
Yeah, absolutely. Thank you so much for joining the podcast.
Sure.
So we're gonna dive into some of the inventory that we're gonna start to release here with us at Rent to Retirement. We're so excited to work with you and your team there in the Rosharon, Texas area. But before we get into that, tell us a little bit more about you and kind of how you got started in the real estate world.
Sure, happy to. So I started in the business quite a long time ago, almost 30 years ago. I've spent the majority of my career in institutional real estate investment, very heavy with traditional multifamily acquisitions, asset management, and development. I started my career with a company called Principal Global Investors and then spent 15 years with BlackRock up until 2021.
I wanted to maybe touch on that really quickly because a lot of our investors are either newer to investing in general, right? Which is great because we like to be a platform where people can be educated, or they're already educated in the training wheels of real estate, right? For an example's sake, but are looking for more of a specific hand in what the next market might be that would be helpful or what a property type would be, right? And you've seen so much of that in your time at BlackRock and in institutional investing. What have you noticed from the institutional space that is really carried over as you were working with more retail buyers now?
Yeah, I will tell you, it's looking at how the institutions have participated in the single family rental space. It's a really interesting case study. And if you go back to post GFC days when the aggregation of scattered homes really became a thing, and this entirely non-institutional investment class was born out of, a lot of it was, some great work from a lot of different people that helped to overcome. The biggest problem was the inefficiency of managing large scale portfolios cost effectively. And so that problem has been solved in many ways by a lot of the institutional players and the participants in that space. But if you look from, let's say 10 years ago when the build for rent phenomena really became a phrase that we all talk about in the industry, the institutions really flocked to these purpose-built communities that are built at scale with a rental business plan in mind. And in my opinion, that's where, let's call it, the smart money has decided to play here over the last decade or so. And it's not to say that owning scattered homes isn't a good idea, but it comes with a different layer of risk, and it's a harder problem to solve. I took away from my time in the institutional space, and that brought us to building these communities of single family rental homes in a scaled environment, and putting a professional management overlay over the top.
Here's the part most real estate investors don't think about until it's too late. Buying the property is the exciting part. How you own it is the part that can protect you or expose you. A lot of people rush to close, file a quick LLC online, and assume they're covered. But owning rental real estate without the right structure can leave you vulnerable when something goes wrong. And eventually something does go wrong. A tenant issue, a dispute, a claim, a lawsuit. That's when investors find out whether their setup was actually done right. An LLC can be one of the smartest ways to hold real estate, but only if it's formed properly and timed correctly. That's why Rent to Retirement works with NCH. They've been in business for 32 plus years, formed over 250,000 businesses, and they focus on getting it done right for the first time. If you want more confidence in how your rentals are owned, go to nchinc.com/RTR. That's nchinc.com/RTR and get your free Wyoming Advantage guide that tells you why you should protect your real estate investments with a Wyoming LLC. Here's something most investors don't know yet. Congress just passed a hard cap on how many homes large institutional investors can acquire, and the big players are already pulling back from some of the same markets where your best new construction deals exist right now. Meanwhile, builders need to clear inventory before July 1st, and they're offering up to $48,000 in concessions to make it happen. Less institutional competition, historical incentives, turnkey new construction with 17 to 19% ROI. Rent to Retirement sources the deals, Blueprint Home Loan structures the financing to put maximum cash flow in your pocket. Visit renttoretirement.com and reach out to Blueprint at blueprinthomeloans.com/rent-to-retirement or call 888-343-1043 to talk financing. Did you know that build-to-rent construction starts have more than doubled since 2019? That's not a coincidence. Major institutional funds, REITs, and private equity have poured billions into the BTR sector because the demand fundamentals are undeniable. Homeownership affordability is near historic lows, and millions of Americans want the lifestyle of a single-family home without the financial commitment of buying one. Our partners at ROI Property Group have been building master-planned BTR communities for more than a decade, with over 1,200 units built, developed, or repositioned. Learn how they do it at roipropertygroup.com/RTR. Before you and I go down our professional rabbit holes, because we both love talking real estate, for everyone out there listening, right? When we talk about institutional buyers, just because I think that's something that people hear in the news a lot, right? I want everyone listening to understand that that is entire venture capital firms or entire companies that pool together millions and millions of dollars from investors all over the nation or all over the world, and they have a fund, right? They've taken all this money and they have a fund where they take those funds and then they're purchasing sometimes hundreds or thousands of doors at once. And so they're purchasing these as part of a portfolio for a group of investors. When we talk about a retail investor, that's you and I, right? That is John Smith and Nancy Drew up the street who have 3 kids and a modest living, but they're consistently purchasing in real estate. Or your physician or your attorney or your pilot that has a job, but they're also investing in real estate as an individual, right? They're not investing as an entire venture capital firm, right? So I appreciate you clarifying that or kind of giving us the difference there. Now, pivoting a little bit, you have all this background and this working history in the space, but then you're transitioning it over into the retail side, and now we're here with Houston, a Houston suburb with new construction that's already tenanted, right? Tell us a little bit about both the market that you opted to work in and kind of the why behind it.
Yeah, so the Rosharon submarket on the south side of Houston is incredibly appealing for many reasons. The first being it's situated in a highly desirable public school system, the Alvin ISD. Secondly, we were able to acquire a lot position inside of the Sierra Vista master plan community, which is very highly amenitized community with over 2,000 homes, and we've built a small section of that overall 2,000 home development with rental with a rental business plan in mind for the homes that we built within that section. So what our residents benefit from access to incredible amenities, true resort style amenities. That resort style is massively misused by our industry, but when you see what our residents have access to: lazy rivers, pools, sport courts, everything you'd ever want, a clubhouse, it truly meets that definition. And so beyond outside of the community, Sierra Vista and Rosharon are incredibly proximate to one of the largest employment centers in the state of Texas. It's the Texas Medical Center. It's just due north of our community. Over the last several years, there was a significant improvement and expansion of Highway 288, which is the main shot straight up into the Texas Medical Center from our community. So our residents who work in the med center benefit from as little as a 15-minute commute, whereas prior to that road work being completed, that was a much longer drive, and it really opened us up as an option for folks that work in that incredibly important and massive job center that is the Texas Medical Center. And it's not just the med center. You have the downtown Houston. There's several significant employment centers scattered around the metro area, and with our proximity to Highway 288, which connects you to all of the main arterials, that's a huge advantage that our residents really value about our location.
I love that. Thank you so much. It's just because a lot of our listeners, right, have already been educated from rent to retirement and the readings that they've done online, they can hear what we talk about when we're talking about secondary and tertiary markets, right?
Yeah.
When we talk about big cities, everyone thinks New York, LA, DC, Chicago, which absolutely correct. Those are huge cities. People are sometimes surprised when I talk about Houston being the fourth largest city in the nation and it just being so sprawling. So Houston, downtown Houston, Houston proper, you have really good purchase prices. Great. But then the secondary and tertiary markets like Rosharon, where that we're talking about here, it's still in the path of progress, right? So as this Houston city center grows, the outskirts grow. And as the outskirts grow, you have markets that you're in, for example, that are growing as well, both from an appreciation standpoint in terms of the home value, but then also the tenancy as well. The market is incredible. You and I have been talking at length as far as it being new construction. So that part, I think our investors are used to. I do want to pivot a little bit and spend some time to what is really different about your team and what we're excited to see in action, right? Which is the property management side. A lot of our investors are just busy professionals. They don't have 10, 12, 15 hours lying around to be in the weeds of managing their manager, right? Or managing the specific tenant. And an example that you used in a meeting of ours that I loved was Matt, you said, "Hey Matthew, I want you to imagine an apartment building, but instead of one building with a bunch of units, it's these single family homes, all with their separate values, separate tenants, but it's managed in the same way." Can you speak to that and kind of the property management that you built out with your team there?
Sure. Yeah. And the apartment example, I think, is an important one. You've heard me talk about the power of scale and the benefit of scale. And as you know as well as anybody, when you have a large enough number of units that are in close proximity to one another, your ability to cost effectively manage and maintain those homes and provide excellent service to your residents and importantly to us, our investors, it's greatly enhanced by the fact that we have a large number of homes built contiguously that allow us to have an on-site full-time maintenance supervisor dedicated entirely to this community. We have a full-time on-site community director who oversees all things management, leasing, and resident relations. You're not able to pull that off unless you have the power of scale and the benefit of scale, which we're able to bring in and share those benefits with our the investors who are acquiring homes from us and now partnering with us on the management side.
Yeah, I love that. That's incredible. Just because, like you already mentioned, right, when you have these tenants that have all of these luxuries that do love being where they're living currently, making sure that that's as quiet as possible, right? What I mean by quiet is even in the process of you guys selling a property to one of our investors, that there isn't a bunch of clunky moving parts for the tenant and that they're not disturbed, that they're still happy and wanting to stay there for years to come. That's incredible.
Yeah, and if I could add to that, Matthew, they so many of our residents are coming. They're leasing a home from us, and they're living in a home for the first time, and they've come from an apartment environment where they have grown accustomed to very high touch maintenance or management and maintenance from their property managers, which works well in that large scale format. And so for them to come to us, we hear it from prospective residents all the time, or from our existing residents who we survey very frequently, where they talk about making that coming outside of an apartment environment was and losing what their concern was, losing that great service that they were accustomed to in those environments, uh, where we're able to pick up and really enhance the service offering beyond what they've ever experienced in an apartment environment. That really stands out in our residents' mind as a reason why they choose to stay with us for as long as they are.
Yeah, absolutely. That's incredible. So I love to ask this, especially from the perspective of providers that we're working with. We have a lot of investors who are investors and understand the game, right? And that is amazing to work with. But we have a lot of people who have been on the sidelines. right? For one reason or another, they're either still researching or they're still vetting markets or property types and trying to figure out what makes the most sense for them. Our inventory, Ryan, as you're familiar, and anyone listening, our inventory, it's about 60/40. It's about 60% new construction and then 40% properties that have been renovated within the last 3 weeks. But for anyone looking at the new construction specifically and looking at your properties or considering Rosharon, what would you say to the investor who might be nervous, who's still on the sidelines and wanting to look for a reason to kind of jump in? What would you say to that investor, Ryan?
The first thing I would say is those investors that are spending that amount of time and energy on diligence in the way that I know that you believe in so entirely, I give them a pat on the back because it's the
Mm,
right way. Especially these are significant investments. These are real dollars that we're talking about that are meaningful to us and all of our investors that we work with. So continue to stay diligent. And my I'll speak specifically to the Houston market, but I think these comments apply nationally.
sure.
The Houston market had seen significant new construction deliveries, not just in single family homes, not just single family rentals, but also in the apartment space. And over the last 2, 3 years, the market has been soft, it flat to soft, and but those deliveries that had been weighing on the market over the last several years have come to a stop, and we are, in my opinion, on the front end of a really favorable, a couple 2, 3 year stretch where that supply demand imbalance is going to move in the favor of folks who own homes, especially people who are acquiring high quality homes in highly desirable pockets of Houston. uh, Again, I think now's a terrific time to continue with really smart diligence and to be waiting in on some good investments.
I love that. I appreciate that, especially the insight from someone who's been in the realm for so long, like you have, right? So that all said and mentioned, at the time of this release, your inventory will be live with Rent to Retirement. So we're so excited for that. For everyone listening, again, renttoretirement.com. You'll see the Rosharon inventory there. Purchase prices under 315. Right. So to be clear, these are single family homes, right? Completely separate of one another. They're not, $500,000 single family homes. These are really, really quality, newly constructed properties with a property management team already in place, and in most cases, the tenant already in place as well. Did I miss anything with that, Ryan?
I would simply say that beyond the benefit to our residents that having a dedicated on-site team, and those benefits are significant. We're able to respond to maintenance tickets and resolve them well under a day. Our average is less than a half a day before we can resolve a maintenance item. It's worth noting that the way our management construct or contract is constructed is that our investors benefit from the fact that if a resident submits a maintenance ticket that our on-site team can resolve in 15 minutes or less, then the investor doesn't get billed anything. Whereas, obviously, if you don't have the benefit of scale, which allows for the on-site presence, you're rolling a maintenance tech out to evaluate every maintenance ticket, and that doesn't happen for free. So we're able to pull that off. Yeah, in addition to the speed at which we're able to respond to residents' needs, the expense that our investors incur for so many of the things that happen in the normal life cycle of owning a single family rental property, we're able to do that very cost effectively. Our repair and maintenance expense numbers are a fraction of what we see published by the broader industry. Our turn cost the same. Our average turn cost over the last 12 months is $1,600 per turn. Our retention rates within the community are north of 70%. The community as a whole is occupied currently at 93%. Um, the power of our approach to managing these homes is bearing out in the numbers, and I'm eager for you and for your investors to get a closer look at those numbers, at the appropriate time, Matthew.
That's really exciting, especially for our investor base, because a lot of the reason that people are going turnkey, right, rather than, and this is a question that I get all the time, so I appreciate you passing this to me, but a lot of the reason people are going turnkey rather than maybe going at it themselves, one is the volume of the relationships we have, right? The fact that we move so much volume allows for us to get in touch with people like yourself who have a very specific inventory for a very specific type of investor. Now, can the average investor go to Zillow or Realtor.com and try and figure it out themselves? Absolutely, right? We're not going to be disingenuous and say it's impossible. That said, where it is specific to rent to retirement is that a lot of people are buying one, maybe two, maybe five properties a year. With rent to retirement, as a marketplace, we're doing 40 transactions a month on average. And so at that volume, it just allows for us to, one, negotiate with sellers, but two, allow for us to find property management teams, selling teams like yourself who have this infrastructure already in place, right? You are then not John Smith with one property on the phone from a distance, hoping that you're able to get a hold of a property management team you trust. We've already vetted we've already vetted you and your team, so we're really excited for our investors to be able to witness that up close and personal as well, and the long-term ROI benefit to having a tenant renew their lease consistently because they know the property management team, because they're aware of the office team, right? I think that really goes a long way. So, Ryan, we really appreciate your time and thank you so much for talking with us today. And thank you all out there for joining us to get yourself educated. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.